Hello everyone, it is Sheen Trades. I'm a co-founder of TraderLink, and today we will be going over the Gamma basics. So to start this off with a sort of lesson overview of the class today, it's going to be what is Gamma, what is net Gamma, what happens with the two different environments of positive and negative, what is the AOI, as well as how to use gamma exposure as support and resistance, as well as how to identify potential chop. Um, the one thing that I want to make clear is that on the class on Thursday, we will be diving deeper into how to interpret more specifically positive and negative gamma exposure. But as for today, we're just going to go into the very basics, right? Because once again, reinforcing the basics is how you essentially get to know and understand the deeper dive into it. So starting off, what is net gamma and what is the total amount of money being moved? So when we talk about net gamma, we talk about this more specifically, this number or this value at the top. With this number specifically, things that we watch out for. When it comes to the specific value wise, we typically like to look for a plus or minus 3 billion, right? Why? When it is above or below this plus or minus 3 billion, what happens is that the environment is more stable. And the reason we look for more stable environments is because if the environment is consistently changing from positive to negative, it's going to change the hedging requirement per se of certain levels. So with that being said, that's why we kind of like to wait and watch for a plus or minus 3 billion. So anything above 3 billion or anything below negative 3 billion. Um, does that make sense so far? Once again, for those who were here in the past, I know that this is going to be a little bit repetitive, and I want to make clear that we're here to reinforce the basics. So continuing forward, um, what happens when gamma is positive? What does that mean for the market makers and market dealers? So when the environment is positive, I kind of want to get to a blank page here. There we go. We'll rock with this for now. When you have a positive environment, so positive um, environment, ENVIRONMENT, right? So when the gamma exposure is positive, what happens? What are market dealers doing as the basic concept of hedging, right? So when the environment is positive, what happens is that dealers are going to play against price action. So step number one is going to be understand that dealers are playing against PA. And my dog is choking, if you heard that cough. But anyway, continuing forward, playing against PA. What does that mean? So if the market is ripping upwards, what are dealers doing? They're going to sell the rips, right, and bring it down. And if the market is dipping down, what happens is that they're going to buy the dips, right? They're going to buy up the dips. And what does this create? This creates more liquidity within the market, right? Liquidity. And what does more liquidity mean? It just means that there's going to be less volatility, right? Less volatility, right? So these are just the basics of a positive environment. So dealers play against price action, they sell the rips and they buy the dips. So now going over that, or now having gone over that, what happens in a negative environment, right? So let's get rid of all of this. It's going to be a vice versa situation. So negative environment. Let's get into negative environment, right? So if we are in a negative environment, what does this entail? So getting into it again, market dealers are going to be playing with price action. So play with PA, right? So this is just the sheer basic. Is it going to happen every time? Inherently, no, right? But this is just the basic. So that's why in more positive environments, you tend to often see slower days in terms of the price action or movement wise, because everyone is they're kind of playing against each other, right? Market makers versus market dealers. Um, So what does playing with PA mean? So if the market is ripping, right, market dealers will play with it and continue to buy up, right? Vice versa. If the market is dipping down, what happens? Market dealers will also sell with the dips, right? So what does this create? Less volatility. So less volatility. Oh, sorry, not less, more volatility with negative, more volatility, more, right? So more volatility and less liquidity slash less liquidity, right? So once again, positive environment versus negative environment. Positive means playing against price action, you know, selling the rips and buying the dips. And when it comes to a negative environment, they play with the price action. So they continue to buy the rips and they sell the dips. Um, so an interesting thing is, okay, you would kind of assume that this would be very directional per se, right? So I want to make relatively clear how this can look in certain situations. To be more specific, so neg uh, environment. Oops, I can't spell apparently. We'll just leave it like this then. Negative environment. Neg ENB, right? What does this mean? So this can entail different things in terms of the price action. If price starts dipping down, right? And then all of a sudden it starts slowing down, and then you start seeing a small bid up. What happens is that dealers will continue this bid up and play with it. It's not going to be straight down the entirety of the time. No, if the price action changes, then dealers will play along with it. So that's when you can potentially see sometimes those V-shaped recoveries, and that's due to dealers participating within the same direction as market makers or institutions. So that's just something to take into account. It's not always going to be very one directional. But if the price action changes, then you'll see something like this where you get a V-shaped recovery, or a V-shaped reject, or I guess top per se. Also, thank you to Liquidos for answering some of the questions. I know I'm kind of teaching, so I'm not really looking at chat right now. But if you do have questions, you can save them for the end. We always have a short Q&A at the end. So getting into the next portion, the next one is what is the AOI? So for those who don't know and who are new to this, the data section of this, the AOI is known as the area of interest, and that's just a coin or a term that we coined and got really tired of saying, oh, the largest exposure, blah, blah, blah. And what does the area of interest represent? So when it comes to gamma, the most interesting part about it, in my opinion, is that it oftentimes gets mistaken for being the absolute magnet in certain situations, but that's not entirely true every single time. Vana is actually the magnet, and we'll get into that on the next classes next week. But with gamma, the easiest way to play with gamma, in my opinion, is going to implement support and resistance. So certain gamma levels, the AOI is pretty much just another gamma level. However, it's just going to be the area in which the market will have more of a reaction in comparison to everywhere else. So AOI is just the largest exposure. And with that being said, it is the largest exposure on the net raw chart. So as you can tell right here is 4750 AOI. And, we already have the data marked out for you for those who don't know about this already. But it's just the largest net exposure on the raw chart. So what happens at the AOI, and the reason why it's very important, is because since that is the essentially the level with the highest gamma exposure, what happens is that's going to be the area within the market that you'll see some form of a reaction. In comparison to other levels, that's the area that's going to be the most interesting, hence area of interest. So in this case, what you can kind of look at is, let's flip to a SPX chart. How I typically like to go about teaching people and what I recommend off rip for people to learn about gamma and easily implement it is step one is just marking the AOI, right? It's going to be the easiest way, as I said, it's going to be the area within the market that has the greatest reaction. So we'll just label this AOI, you mark it on your chart, and that's step number one, right? That's the easiest and simplest way you can immediately start implementing gamma exposure is mark your AOI, and then from there, you can start marking other smaller gamma levels, right? So in my opinion, when I see this right now, there's no other level that, in my opinion, that is worth marking. Once again, we're very far from these strikes. So until we get closer to those, then, it'll be somewhat interesting to me. But as of right now, it's not close enough for me to really give a shit about, if I'm being honest. Just being flat out. But yeah, 4750 is going to be the area that I suggest you start marking the area of interest on your chart. You can treat that as support and resistance, and that's essentially the best way to identify, the level for the day, right? The key level for the day. So the next thing that I want to talk about is how to utilize it as support and resistance in a more specific way. So once again, you can use the AOI right here like this. The thing is when you approach, so the super basic concept is, okay, if you approach a gamma exposure level, there tends to be resistance or support. However, in the next class on Thursday, we will get into a little bit more specific in terms of why is it going to be that way, right? If it's positive exposure, what happens at positive exposure? If it's negative exposure, what happens more specifically at negative exposure? Is it above spot? Is it below spot price? We'll get into all of that on Thursday. I don't want to spoil too much of it because I think, getting down the basics and reviewing all of that is going to be very, very important to the structure of the learning aspect here. But continuing forward, the next one that I want to talk about is how to identify potential chop. We get this question a lot, right? Ever since we started, this is one question that we get all the time. And the easiest way for me to answer this is if you have multiple AOIs, right? What happens when you have multiple AOIs is that there's certain areas of the market that's pulling and pushing towards each other. But when you have those multiple AOIs, it's kind of a defined range for the day per se. So let's say you have a level at 47.25 and a level at 47.40, then you can kind of expect that to be the range for the day. The thing about gamma exposure that you want to take into account is when dealers are out of the position. And then how do you know? Is that you see that exposure bar shrink, right? Let's say at 10 o'clock, right, a.m. EST. It looks like this, right? You have the bar, you have one big exposure bar, you have a couple small ones everywhere else, right? And it looks something like this, right? Let's say spot prices right here. Let's say we finally get to this level right here where the AOI is, and we start pushing above it. We start pushing above it. The thing about understanding how total delta works and how the delta changes and if it moves up, what happens if we get above it, what happens, the most important aspect, in my opinion, is seeing that this exposure bar here kind of disappears, right? That means dealers are slowly getting out of the position and they're repositioning into something else. And their hedging requirement becomes different depending on, where the market is. So that's kind of what we like to see is like, okay, let's say you push up, you want to see this bar kind of start disappearing and get halved per se. And then let's say we're here now, you want to see another pickup of the exposure bar, right? Of the one that's above it. And the reason I say this is because then you'll likely see, okay, market dealers are kind of expecting the market to push up here. So if it pushes up here, what is their next step, right? Because now this one's out of the picture, and now we're focusing on this one as the AOI. So it's just understanding how the data moves in terms of, okay, what happens when it diminishes, what happens when it starts increasing, right? That's when you can kind of see continuation per se. But something like today, that's very interesting, if I remember correctly, was that we broke this low of day area and we came all the way down. But from my understanding is when I was looking at it, 4740 AOI was still there, right? It never went away. So when we broke below, it was only the market dealers were still playing this 4740 area. So with that being said, it managed to push up a little more back to 4740. but that's not going to happen every time, right? I don't want it to be like, oh, it stayed here, so even if we keep falling, then market's going to push right back up. No, that's not how this shit works. Is it's going to always be changing. So if it manages to stay, then there's something a little bit interesting about that. That should pique your interest. Like, okay, do we actually end up pushing back up, right? So the overall suggestion here is to spend more time watching the data and see how the market reacts with it. And create your own sort of like theory, right? Um, but continuing forward, that's kind of all I really have left. And let's get into a Q&A. I hope everything I said was clear. If it wasn't, I can reiterate, just to make it a little bit simpler if not. But I'm gonna open up the chat and see what happens. Thank you, Liquidos, once again for answering some of these questions, but there's a long one here. So, okay, last questions. So can better follow along. I'll save anything else for the Q&A, but at the end, but this is a plus minus 3 billion for SPX is also current gamma. Is that also the current gamma at the spot, or is that the overall daily volume number independent from the gamma exposure at spot, or is it total gamma exposure across all strikes? I've been trying to find the answer, so I'm not really sure. It is required heading. We are using plus 3 billion net gamma to identify if we are in a pause. Yes, that's pretty much you're using not plus minus 3 billion. That's just what we like to look for in terms of a more stable environment. But if it's a positive number, you're in a positive environment. If it's a negative number, you're in a negative environment. The thing is that you just want something a little more stable so you're not constantly flipping back and forth where the hedging requirement does change. I personally don't really look at delta adjusted. If I'm being honest, I kind of just look at raw. I have it on there just so I don't have to flip back and forth, but de-adjusted is pretty much raw without all the noise, where it now takes into account, if I remember correctly, a little bit more delta exposure as well as changes in implied volatility. So yeah, thank you, Willie, for that one. That's exactly what it is. Long question. Wait, no. Can you go over the way to identify chop through GEX? Maybe I didn't understand. We want to see AOIs reduce. Sorry. Yeah. So when it comes to identifying chop is when you have multiple AOIs. So something like this, where you have something like this, smaller one, smaller one, smaller one, regular size, and then you have another one that's equal amount and it's distance out. And you have another one over here that's the equal size and distance amount, right? So it's kind of just you have multiple AOIs in which market has to hedge at certain situations. So something like this, something like this, and something like this. And you have three relative AOIs here, right? Because the AOI is always going to be the largest exposure. But when you have three, or you have multiple large gamma exposure strikes, then you're going to be like, okay, that's a little bit odd. Then you can identify that the range is going to be something like this for the day, right? It'll be like from here to about here, right? That means through everything in the middle here is going to be relatively choppy. And it's not that you can't play it, it's just that it's not as directional as we'd like it to be. Could you explain what the calls and put percentages volume mean and volume and values mean? Yeah, I mean, that's not the class for this, but I can definitely just talk about it in general. So the call and put percentages, it's just the total, I guess value that came in, right? So you see this value right here, and you see the value right here. If you combine the two values and is it volume wise? Let's see. I don't use the unusual options flows often, so I want to say that it's just 60% of the flow that came in were puts, and 40% of the flow that came in were calls. Trying to figure out exactly what it means. I'm not an unusual option specialist, so bear with me here. I focus more on the exposures, so I think that question is better suited for Mitchell, and I don't want to give out wrong information. So Yeah, so it doesn't take into account sold or bought, so there's no bearish or bullish bias here when it comes to whether it's just calls or puts, but usually under the bid for any situation. So think about it like this. The best way to denote this, from my understanding, is that let's say you're buying a regular option, you yourself are, right? Usually, if you want to fill right away, you fill the ask, whether it's a call or a put, you're still filling the ask. Um, and in my experience, when I sell options, like when I go covered calls and stuff, I'm always selling at the bid, just to get filled faster. Right? So if it's and obviously short calls are bearish, long and short puts are bullish. Gamma's negative dealers are buying the rips, like pushing. Yeah, they're pushing the market. So they're playing with price action. Look at those. Could you break? Why would dealers buy the rips or sell the dips in a negative? That would push down or up the market in further same direction. Why would dealers? It just depends. I mean, that's just the environment basis, right? It's can we go over paper handing? Someone's trying to troll me, bro. How do you personally interpret split gamma AOIs? So actually that's a good one to think about. One thing that we'd like to watch out for, see if I can get all these colors right, is let's just take a white bar first, white line, and then we'll do a red one, right? Something like this. And then we'll take a green color, and then we have something like this above, right? That's not equal. It's not very equal. Do it like this. Close enough, guys. You get what I mean. Let's say these are relatively equal. Then obviously on the chart for net, so this is split. So sometimes something like this may look like this on split. It'll end up looking like, we'll just grab a light blue color. May end up looking like, I don't know, like this, right? So when you see something like this is what we like to, another term that we coined, just based off of theory, is that this is what we call a split divergence. Split divergences are interesting. The play or strategy that we use with this is that we kind of end up gravitating towards that split divergence. Does it happen every time? No, there have been multiple times where we've, us traders even have been baited, thinking that, okay, the spot price is right here, and there's an AOI further down right here per se, right? And spot price is right here. And a lot of the times we expect the move to go down to the AOI, but it's not entirely always the case when you have a split divergence, is that, okay, it may actually end up pulling towards that direction instead of towards the AOI. So it's not always, does it always work? Definitely not. It's it's hard to interpret completely, but it's just something that we've noticed. So just keep your eye out for split divergences. Split divergences obviously are going to look like, as I just drew, it's going to look like this. So like this little section right here. So this is what the split version looks like. And then that same on the net looks like this. AOIs I just kind of use for a key level for the day, right? That's all I pretty much use it for. Okay, if we're at the AOI, what position can I take in order to continue the continue making, or what position can I take for a trade at the AOI, whether that's short or long. We'll get into certain situations, but it's because of different exposure flows like Vana and Charm, it's very easy to interpret what may happen at an AOI, right? We'll get into all of that. I don't want to spoil all the juicy details. Thank you, Willie. That's a good thing to talk about. So market dealers, a lot of people always get confused. Like what are market dealers versus market makers, right? They're definitely different. Dealers are writing the options to you. So if I buy a call, they're the ones who sold me said call, right? That means they're short that call while I'm long that call. Um, but yeah, when gamma's negative, dealers are buying the rips, like pushing my. Oh wait, I already saw that one. Which direction? Yeah, they don't give a shit which direction it goes. They're just balancing their books. Can you go over how to determine choppy or not? I already did. When you're making it, on your candle charts, what time do you look at? I just look at it continually throughout the day. I mean, if it changes, it changes. But it's just marking it on your chart and as easy as dragging it in a different area. So that's pretty much all in terms of this. But yeah, that's the easiest way. It's just mark gamma levels, right? Then you can just mark it like this. Let's say we had a positive bar at 4760. All you have to do is just do it like this. This is my suggestion. Take it with a grain of salt. But let's say it's positive exposure, positive depth wall. So I'd label it. Let's say we have something below, like all the way down here. Then I would just label it. I'll do 4715. X negative. Yes. Floor. Right. Just wall, floor, depending on where the spot price is. Yeah, Alejandro's in chat with a freaking troll name. So typical. It's like the short guy energy. Why do dealers have to hedge? It's to balance their books, right? So what is actually I didn't even go over that. I guess it's good to go over. So what is dealer hedging, right? Dealers want to stay delta neutral. Delta neutral, right? What does delta neutral mean? It means that their delta is at a zero, right? So how do they make money? They make money in between the spread, and contract fees, essentially. That's essentially what they're doing. They don't care where the stock goes, up or down, they're hedged, they're delta neutral. Their delta's a zero, so whatever direction it goes, doesn't really matter. But we're playing said hedging, right? So when we play with the hedge, that's how we capitalize potentially. But how to understand the delta hedging a little bit more. I mean, may as well get into the nitty-gritty of it, right? Remove drawings. So let's say dealers have a we'll call it DD, dealer delta of 0.5, right? Let's say, or that option has a 0.5, right? What do dealers need to do in order to get to delta neutrality? Right? If the delta is at 0.5, for every dollar that the stock goes up, then the value of the options contract will go up by what? $50, right? Right, guys? Hopefully that everyone knows that. $50, right? So with that being said, how do they hedge a positive 0.5 delta? They have to short 50 shares. So even if the stock goes up, then the delta will be zero, right? So they are short 50 shares, right? To offset that delta, short 50 shares, right? So what happens and why is this important is as this delta changes, right? Let's say it now goes to 0.6, right? What happens now? They have to short another 10 shares, short 10 more shares. Obviously, this is a very basic and small amount as an example, but you get that if the delta is at 0.6, depending on how much money there is and what the total hedging requirement is, that can change. This number is always going to be in the billions or if not millions, right? Or millions, if not billions, however that saying is, but they have to short another 10 shares per se to match this delta. Once again, maintaining something very simple, but this is on the level of, okay, let's take it at this level, it seems very small amount of shares. Yeah, 10 shares isn't going to move the dang market. I can go buy 10 shares of Apple. You can go buy 10 shares of Apple, and we're not going to make the market move. However, dealers aren't just short one contract. They're not, they're not long one contract or short one contract. So 0.5 delta can be long calls or short puts, right? Those carry positive delta. So with that being said, they're hedging that delta by shares. And let's say they're in the 10,000s contract of 10, they're in the amount of 10,000 contracts, 100,000 contracts or whatever, right? That means they're shorting millions of shares or they're longing millions of shares every single time that delta changes. So, yeah, that was so the last 30 minutes of market, that was a footprint thing that I was watching. Um, how this number right here. So the deltas on our footprint chart show up at the very end. No, sorry, not at the very. They only show up on diverging candles, meaning if this candle is red, right, and there's a positive delta here, or that candle had a positive delta, what does that mean? Although this was a big red candle and some people could mistake it for a bearish candle, there were actually more buyers than sellers on this candle. However, just looking at the anatomy of a candlestick, then you're not going to be able to see that, right? You're just going to be like, oh, big ass red candle. That means this could continue down. But no, that's not the case. There were actually a lot more buyers than there were sellers on this candle. So that's when it kind of piques my interest when it comes to the footprint chart. Same with this one right here. Okay, this is a big old green candle. We pushed all the way up. However, there were actually more sellers, right? We have a negative delta here. And guess what happened? Kind of fell down. Market came back down. Same situation here. Positive candle, I mean, negative candle, positive delta means more buyers. We ended up shoving up. And this candle is from 11 to 12. But yeah. Right. This I know we're on exposures, but may as well get into, in questions in general. But yeah, so this is essentially like why we have these deltas because it makes understanding the actual candle a lot better. So a candle like this, right? No delta at the top because there were more sellers, right? Candle like this, once again, there were more sellers. And then all this blank space up here is just hilarious. Sorry, what? No one caught that. Maybe somebody did. Who knows? I'm just playing around, guys. Funny stuff. Yeah, you definitely to run this footprint chart, you need if you are running footprint plus tape plus unusual options when it's on all, like this morning, I was pushing 25 gigs of RAM. So that's a lot. That includes TOS, TradingView, every tab that I have open, Discord, Spotify, WhatsApp. Um, it's definitely it uses a lot of power, like, and that's also why, and that's me including me streaming. So, although I don't even need 64 gigs of RAM, I just bit the bullet and did it because it just makes it a lot easier, less things to worry about. The computer won't be slow. And yeah, so it's the jet lag. Yeah, Alejandro, 64 gigs of RAM. I'm gonna stop this recording so I can relax a bit.